Yes, we are live.
Still not visible in YouTube, I think.
It's coming, sir.
Okay.
Yes. Uh, Welcome, everyone. Uh, I'm Kavin from FinB of SICASA. Uh, Thank you so much for joining this session. Today, we got CA Dinesh Jain, sir. He is for our session faculty. He is a director at LRK Advisors, a true expert in the world of credit ratings. With over a decade in this field, Dinesh Jain sir has led analytical operations and headed 30-member team diving deep into the credit assessment space. He's not just an industry pro, he secured all-year rank in all the three levels of CACOs. Dinesh Jain sir has worked extensively with major corporate clients across diverse sectors nationwide, bringing that in-hand expertise. His tenure at Chrysler included chairing rating committees, offering a broad perspective on the financial matters. Before that, he was with EY, sharpening his skills in risk advisory services. Beyond his professional journey, he's been sharing his knowledge for a solid 10 plus years at coaching institutes and on his through YouTube channels with the thriving community. His insights have been featured in leading newspapers, adding weight to his expertise. So get ready to dive into the insightful discussions with CA Dinesh Jain sir, our guide through the world of financial management. Thank you so much, sir. With this note, I request sir to take the session.
Thanks, Kevin, for this wonderful opportunity given to me. I am very grateful that SICASA is conducting something like this for the student community and community at large. I got to hear about even your other presentations which have happened on this topic, that is the investing topic, which is an area which many of us need to start at an young age. So thanks for the opportunity, Kevin. uh, I'll start with the mutual fund part. So I would like to make it more interactive for you guys, so that in this presentation you learn about why mutual funds investment is needed, and also learn about investing at large, because there are multiple modes of investments which are available. So it would be good for you to learn about different aspects of investments, and in specific about mutual funds at large. So can you tell me what are the various modes in which an investment can happen? You can just type it in the live chat box. What are the various asset classes in which an investment can happen? So you can let me know those asset classes where you can do your investments. Okay, SIP, SWP, STP, shares. Okay, so there are multiple asset classes in which investments can happen. I can broadly categorize them into the riskier one and the risk-free one. That is how I would like to classify them. There are certain which are risky in nature. There are few which are risk-free in nature. Yeah, like fixed deposit and other thing. So the first category is these. That is fixed deposits, PPF, gold, NSC, real estate. All these investments which you see are primarily having lesser risk. Some of them can still carry risk, like your gold and real estate do carry some risk, but major chunk of these investments primarily have lesser risk on their side. So FDs normally give a return of 4 to 6%. Your PPF give return of 7%, gold give return of 8 to 10%, NSE give return of 7%, real estate put together, there is a rental which you get and there is an appreciation which you get, all put together, it will give you around 7 to 8% return. So that's the kind of return you will get if you go to the risk free side. Then there is a moderate side and there is an extreme riskier side as well. So I'll discuss the extreme riskier side as well. The moderate side is this, which is the mutual funds, direct equity investments, or exchange traded funds. The mutual funds normally historically has given, there is a equity mutual fund and there is a debt mutual fund. We have two types of mutual fund. The equity mutual fund historically has given a return of around 12 to 14%. That's the return which equity mutual funds have generated in the past. Whereas your debt mutual fund, the debt mutual fund, like your fixed deposits, like your PPF, which are on the lower risk side, give a return of only 4 to 6%. Direct equity, what is direct equity? Is I invest on my own in the equity market. That is, I go ahead and invest directly in the equity market. That can give you very high return. It can give a return which is even higher than the return which your mutual funds are likely to give, but that does carry a lot of risk. Direct investment in equity is on the riskier side. When it comes to ETF is basically a subset of mutual fund. I'll discuss about ETF and mutual fund a little bit in detail as we go deep into the session. The third category, which has attracted a lot of the young investor, which is digital security and cryptos. It can give you fantastic returns, but there is even a possibility of 100% capital loss. So you will have to decide where you want to put your money. There is a low risk side, there is a moderate risk side, and there is an extreme risk side. Even mutual funds is not moderate, it is slightly on the higher side only. But you will have to take a call, where do you want to make your investment, because risk is something which needs to be managed while making investment. Now, why am I starting with this slide is I want to first explain how 1 or 2% difference in return have a significant effect on your retirement plan or on your goal based investing. So let me show you the power of extra 1 or 2% return. So I'll open a calculator for you. So this is our own website where I'm just showing you the impact of making investments and how 1 or 2% makes a difference. So this is the key learning which you should take at this stage, that how 1% or 2% can have significant impact. Let's assume you're investing 25,000 rupees for a period of 20 years. Let me take 20 years as the investment horizon. You are going to invest 25,000 every month for a period of 20 years. That's the horizon you have decided on. Now, let's see what happens if you change your investment horizon. So, let's take 8% or let's take for 6% return. This is what FDs can give you. FDs can give you 6% kind of a return, which will lead to 1 crore 16 lakh after a period of 20 years. Assuming you did your investment and you earned only 6% return, you are going to be left with a corpus of 1 crore 16 lakh. Somebody tried taking little bit of risk and he generated 10%. 1 crore 16 became 1 crore 91. 1 crore 16 has become 1 crore 91 for that extra 4% return. And if you put in mutual fund 14% or 12%, 12 is safer. 2 crore 49, 1 crore 16 has now become 2 crore 49 lakh in case you are willing to take little bit of risk and invest in mutual fund. If you invest on your own, that is, you decided that you will make your investment on your own, in that case you can generate even a 16% return. That can make your wealth 4 crore 37. But investing on your own is extremely risky. Why is it extremely risky? Because many a times people don't know where to make investment. So you can decide how to make your investment. If you invest in a safer asset class like fixed deposit, which is at 4%, or let me take 6%, you generate 1 crore 16 lakh. If you move to risky and get into mutual funds, 12%, 2 crore 49. You take more risk and get some 20% return. You get 7 crore 90 lakh. The values keep changing significantly depending on your risk taking ability. So it is extremely critical that you evaluate the risk which are there whenever you make investment. The first slide is talking on this, that you have three categories of investment. You can go through FD side, you can go through mutual fund side, you can go through digital security, that is crypto. Crypto is something strongly I advise to be ignored, because there are a lot of taxation related issues as well, and there has been situation where people have lost even entire capital. So then what are the two asset classes where I can make my investment? Either go through FDs, PPF, gold, or you go through mutual fund and equity route. ETF is part of mutual fund only, so there's no difference. And how does that make a difference is this. Let's take realistic return of a mutual fund is around 12%. I'll call 12 to be a realistic return. 12 to 14 is what I've mentioned, but 12 is a realistic return. 2 crore 49 lakh. So the first slide, you are understanding that mutual fund is something which is going to help people in taking care of their financial goals, because everybody will have different financial goals. How do you achieve those financial goals? The mutual fund as an instrument, as a tool, is going to help. In this slide, I also want to explain one more aspect, which is starting early. Most of you should start your investments as early as possible. Even when you are a student, you can start making investments. Maybe not with 25,000. If you can afford 5,000, invest 5,000. If you can afford 10,000, invest 10,000. So what is the benefit of starting early? Let's look at this. If you invested for 25 years, that is 5 years early, your corpus is 4 crore 74. 25-year investment gives you 4 crore 74 lakh. A 20-year investment gives you only 2 crore 49 lakh. Look at the difference. For 5-year delay, your corpus is at least becoming half. 25-year vis-a-vis a 20-year investment. So it's always critical that you start at a young age. If you're starting at a young age, you'll be able to generate superior returns, and superior corpus creation is possible. So that is the big important point, or the key takeaway from my presentation. The important takeaway which I want to state at the beginning is, start as early as possible. When you start early, the benefit of that comes to you, because you are able to generate the benefit of compounding. Compounding is considered to be like a eighth wonder. It is like you have your wonders of the world. Compounding is considered to be like a wonder, because it can give you that benefit of compounding or benefit of long term wealth creation. And in that, mutual fund is one of the tool which is going to help you. Now my next question, let's assume a person gets sick. You are getting sick and you want to take care of your health. Most of us, when we get sick, we will go to a doctor and look at the doctor and get treatment from them, because the doctor will be in a position to provide us a better treatment. He will tell us what is happening with our health. He will provide us treatment on what are the issues with our health. But when it comes to mutual fund, or when it comes to your money management, most of us try to manage money on our own. That is, I want to make my investments on own. I am not taking a help of a professional person, because there are a lot of professional people who are there in the market. These people can help us in making these investments. So how do I take the help of these professional people? That is where this mutual fund comes into picture. When it is our health, what we do is, for our health we go to a doctor. Like we go to a doctor for our health, for our investments we have a doctor. That doctor is a mutual fund manager. This guy will take care of your investments without a huge fees itself. The mutual fund manager is a person who is going to take care of your money. He will invest money on your behalf. I'll talk about a little bit in detail about mutual fund, but basically he is like a doctor. A doctor takes care of your health. A mutual fund manager is a doctor who takes care of your financial investments. Whatever financial investments you are doing, the MF manager, the mutual fund manager, would take care of that. Let me go to the next slide. Some one of you have asked whether we'll give you this presentation. Yes, I'll share this presentation. The SICASA team would share that presentation with you guys. So whoever needs the presentation, you will get a copy of that. Uh, so this is the tool which I'm going to talk about, the mutual fund part. Why mutual fund is critical, I've already talked about, because even a 1% variation in return, a 1% variation in return is going to significantly impact your purpose. So what this mutual fund is this? This is what simply mutual fund is all about. I am an investor. I have money with me. I may or may not have financial knowledge. For example, I am an engineer. I do not have background about financials. You may be a chartered accountant student. You have some background about financial, but at this stage, when you are starting your career, you are not aware as to how to do financial planning. You are not aware how to make financial investments. So when you are not aware of all of this, you need somebody to take care of your investment. So the MF manager basically tells that you as an investor give money to the mutual fund company. There's a mutual fund company which is called Asset Management Company, AMC. So you give money to AMC. The AMC will take care of the investment. The AMC is going to take care of the investment angle. They will see whether an investment needs to be done in equity, whether an investment needs to be done in bonds, whether an investment needs to be done in gold. There are different types of mutual funds. I'll discuss about various types of mutual fund as we proceed. But what an AMC is going to do is the asset management company will make investment in different asset classes. That is why when I started, I asked what are the different asset classes. Some of you said about shares, some of you said about gold, some of you said about fixed deposit. All these places also the MF can make investment. So the mutual fund manager is going to make investment in various asset classes which are there. Why is he making the investment in these asset classes? The purpose is very simple. As an investor, you give the money to the fund manager. You give your money to the fund manager. He will invest in securities. The securities will generate return, and this return is passed back to the investor. So mutual fund manager is a financial doctor. A doctor takes care of your health. Similarly, an MF manager is going to take care of your investments. So that is what, in simple words, a mutual fund is all about. We have different types of mutual funds, different categories of mutual funds. I'll discuss on all of them. Before I move to the next slide, in case you want me to discuss something more on mutual fund, let me know in the chat box. Else I'll keep proceeding towards the next one. Yes, mutual funds will give you returns. It will give you capital appreciation. All that is going to come from your mutual fund investments. You can keep interacting in the chat box. I am looking at the chat box and I'll keep responding to you as and when if there is any question there. Okay, what are the different types of mutual funds? Let me first discuss on the structure of a mutual fund. We have three types of structure of a mutual fund. We have an open-ended mutual fund, a close-ended mutual fund, and an interval fund. In an open-ended mutual fund, what will happen is you can make investment at any time, redemption also at any time. You can invest as well as redeem at any point of time. That is a open-ended mutual fund. A close-ended mutual fund is one where investment can happen on one specific date. Redemption can also happen on specific date. So investments will happen on specific date. Redemption will also happen on specific date. You cannot randomly invest or buy it whenever you want. Interval fund is specific date of a month. It will say that you can invest on only 30th of the month, redeem only on 30th of the month. So we have three categories. There's an open-ended fund, there's a close-ended fund, there's an interval fund. Open-ended is investment as well as redemption can happen on any date. January 5, January 10, January 15, January 20. Any date you can make investment. Close-ended fund is basic thing is you can invest as well as redeem only on specific date. Interval fund, specific date only once. It will say once a month, once a quarter. Close ended only once and for all. That's all. It is closed. You do not have a flexibility of investing again. Some of the questions I've got in the chat box, I'll keep discussing them. Is mutual fund only beneficial on long term basis? Yes, I have a slide on that. How long term versus short term investing makes a difference. I'll explain them. Uh, Saket has asked for more knowledge needed on mutual fund. As we proceed, you will see me talking about how mutual fund investments can be done. Whether do you invest for short term, do you invest for long term? How do you select a mutual fund? What is active mutual fund? What is passive mutual fund? We are going to talk on all of these areas as we proceed ahead. So first, I've talked on the structure of a mutual fund. Next is on asset class. That is, the mutual fund can make its investments in different asset classes. It can invest in equity, which is called equity funds. It can invest in debt, that is, it can invest in fixed deposits, it can invest in bonds, that is called debt funds. Money market funds are basically investing in short term securities, investing in short term securities. What is short term securities is you can make investment in something called as a treasury bill, a commercial bill, which are less than a year type, which have a life of less than a year type. And hybrid funds are those where you invest in equity as well as debt. I'm just discussing a little bit on the theoretical aspect. This may not be very critical for us when you make investments in mutual funds, but let me set the tone first. So I'm trying to set the tone about this, that how is the investments going to be done, or what are the different types of asset classes we have. So I've discussed on the structure. I've also discussed on the asset classes. There is one question whether I'll discuss on the taxation of mutual fund. Yes, there is a slide even on the taxation of mutual funds. So we will cover about how the mutual funds are taxed from Income Tax Act point of view. Next is investment objective. That is, when I'm making my investment in a mutual fund, a person will have different objective of making an investment. So we have something called as a growth fund. What is a growth fund is, these are the funds which are investing in companies which will give a lot of capital appreciation. These companies, I'm trying to make my investment so that there is a wealth increase or capital appreciation. As I said, mutual funds can generate you 10 to 14% return, which is only possible if you invest in growth funds because capital appreciation is needed. Fixed income funds is other name for that is debt funds. Debt funds or fixed income funds is the other name. Tax saving funds is for your ATC benefit. We have ATC benefits, which is ELSS kind of a funds. Liquid funds. What is liquid funds is the other name for money market funds. And pension funds is basically those type of funds which can help you in getting regular income after your retirement. Some of the questions which have come, I'll parallelly keep taking them. Can the date of redemption for close-ended mutual funds change in case of emergency? No, you cannot have different dates. But what the SEBI says, or Association of Mutual Funds of India says, is all close-ended mutual funds will have to be listed. So when it is listed, it will be there in your demat account. You can sell it and somebody else can buy it. Normally in mutual fund, what happens is I will redeem it and the mutual fund will make the payment to me. In case of your close-ended funds, if you are in need of money, you can go ahead and sell it in the secondary market, that is in your stock market, through your broker. You sell it, somebody else will buy it and you can get the money. So you can get money in case of emergency. Is interval funds redeemable at any point of time? Depends on how the fund is structured. The fund can structure saying that you can redeem at any point of time, or it may get structured that you cannot redeem. In India's context, I've seen more of open-ended funds and close-ended funds. We have not seen more of interval kind of a funds. So I've talked on the investment objective side. Next, I'll move to the specialty. That is, when you are making investment in mutual funds, we talked about equity mutual fund. All these can be subset of equity mutual fund. Sector funds. What is sector funds is, these mutual funds will make their investment in specific sector. Example, pharma sector. They can make their investment in pharma companies only. They will not make investments in other type of companies, or IT sector. So sector funds can invest in pharma sector, IT sector, banking sector. Sector funds are considered to be slightly of high risk in nature, because you will have to check how the sector is performing. If the sector is doing well, you can make investments at that time. If the sector is not doing well, so you will have to check whether the sector is likely to do well or not. For example, at this point of time, chemical sector is doing well, so people can invest in chemical sector mutual fund, if at all there is a mutual fund which specializes in investing in chemicals company. Or you had IT companies doing well some time back. So depending on your expectation of a sector, you can make investment in sector mutual fund. That is one thing which can be done. Index mutual fund is, in India's context, we have a lot of index which are there. We have an index called Nifty 50. We have an index called Sensex. We have an index called mid cap. We have an index called small cap. So these mutual funds invest in all those companies which are part of that index. In Nifty 50, we may have 50 companies. So this mutual fund will invest in all those 50 companies. Funds of funds is basically something which is going to invest in other mutual funds. Funds of funds. So it is going to make investment in other mutual funds which are there. Commodity mutual funds are those which are going to invest in commodities. And inverse funds is, it is going to take an opposite position. Inverse means taking an opposite position. If you believe something is going to do bad, you can take an opposite position in that, in inverse funds. In India's context, I've not seen inverse funds being there. From a risk point of view, you can categorize them as low risk, medium risk, high risk. Low risk are debt funds, are fixed income funds, are money market funds. Medium risk are your index mutual funds, and high risk are your sector funds, are your growth related funds. High risk, high return. That has to be always clear. When you take more risk, you will generate more return, and when you take less risk, you will have lower return. This is broadly on types of mutual fund. If there are questions on this, you can let me know. I'll keep covering them as we proceed. I'll move to the next one. Uh, Next is role of asset management company. So in case of a mutual fund, I'll maybe come back to the slide in a minute. Let me first discuss this. Regulatory mechanism of a mutual fund. How is a mutual fund created? So how is the mutual fund going to be created? In case of mutual fund, what happens is, there are multiple regulatory authorities which are there. There is SEBI, which is there, which is the primary agency. AMFI, Association of Mutual Funds of India. RBI is there. Companies Act is there. Indian Trust Act is there. All these are having some amount of control on the functioning of mutual funds. On the functioning of mutual funds, we have all these different types of regulatory agency or regulatory authorities. Now, in any mutual fund, we have three major parties. There's a sponsor, there is a trust, and there's an asset management company. Let me give a very simple example. Axis Bank is a sponsor for many of the mutual fund schemes released by Axis AMC. Axis Bank is the sponsor. Then there is a trust called Axis Trust, which is the trust which is going to hold all these investments. And there's an asset management company. This AMC will have a mutual fund manager who is going to take care of the investment. Simple example, Axis Bank is the sponsor. Axis Trust is the trust which is going to take care of the investments, or which is going to be the owner of the investments. And Axis AMC is going to take care of the day-to-day operation. So I'll talk about the role of AMC because that is the most important party in a mutual fund. So this AMC will have a research team and a fund manager who's going to take care of the investments. Some of the comments which have come, that inverse funds, is it needed for hedging? Yes, it can be taken for the purpose of hedging. Now, on the regulatory mechanism, I've talked about the AMC part. That is, there is a sponsor, there is a trust, and there is an asset management company which is there. This AMC is going to involve a research team. In fact, in many of the research team, some of the chartered accountants and the MBA professionals, these people could be working there. So post clearing chartered accountancy, in case you are a CA student, if you are clearing your CA, and then when you are looking at different work profile, working in a mutual fund is considered to be one of the sought over profile. Many people would want to work in an asset management company. So what does an AMC do? AMC is going to do research and analysis of various securities. They will analyze whether it is good to invest in ICICI Bank, good to invest in SBI Bank, or good to invest in Infosys, Wipro, TCS. For every company, there's a research which is needed before making investment. That research is going to be done by this asset management company. The AMC is going to take care of the research component which is there. Once the research part is done, they will make their investments as per their asset allocation. There is always an asset allocation which is there, where they can decide how much they want to invest in debt, how much they want to invest in equity, how much they want to invest in your short term funds, long term funds. So asset allocation will happen, a portfolio will be built, and regular performance review will happen, because they want to ensure that you are generating very healthy kind of a return. It is extremely critical that AMC takes care of how to generate returns for an investor. In my presentation, I will keep talking about how to select a mutual fund, because that is the major ask which has been given to me. How do you select a mutual fund? Because in mutual fund also we have a lot of varieties of mutual fund there. So in that, when we select a mutual fund, most important part is the AMC. How is the AMC performing? Because based on the asset management company, I can go ahead and select a mutual fund. So I've talked about the regulatory mechanism. I've also talked about what role does an AMC play in a mutual fund performance. Now, let's talk about the most important topic, which is equity investing versus the mutual fund. Equity investing versus mutual fund. I think one of the most sought over topic is this, because many a times people ask us, because I am into professional advisory for making investments. So people keep asking us whether should I do direct equity investing or should I invest through mutual fund. First, let's be very clear that you should invest in equities. Equities means investing in shares of companies. How do you invest? There are three ways. One is direct equity investing. Second is through mutual funds. Mutual fund also, you can indirectly invest in equity shares of a company, or investing in unlisted securities. Unlisted security is not very critical, because at this age you may not be in a position to invest in unlisted company, because for unlisted companies you need a lot of capital to make investment, and they are considered to be very risky. For example, you want to invest in one of the IPL companies. There are so many companies, the franchisee which are there for IPL. So you want to invest in one of the companies. So if you want to make investment in one of the company, that can be an unlisted company, you can do through this, but the amount needed and all will be on the higher side. Now, I'll discuss on direct equity versus mutual fund. Direct equity is basically you doing your own treatment. When you have health issues, you want to get treated. If you want to get treated for your health issues, sometimes small problems are there, you can do your own treatment. If you have got some fever, people will say, let's take a dolo, and once you take a dolo, you will get cured. So if you have small problem, you can make your own treatment. But when you have bigger issue, you will have to go through doctors only. You will have to go through doctors for your bigger issues. So when you're making small investments, when you want to take risk and you are okay to invest small amounts, maybe you can try through direct equity investing. But there also there is a problem. When you do equity investments, you need again a sizable amount. Mutual funds can even start with 500 rupees a month or 1000 rupees a month. Direct equity, small amounts are difficult to do. So in case you are confident that you understand about companies, you understand about economy, you understand about the various industries, you can make investments on your own. Otherwise, it is always preferable that you make your investment through mutual fund. That is the advice we normally give. We always tell people that invest through mutual funds in case you are not aware of what needs to be done. In fact, personally, I have put 80% of my investments in mutual funds. 20% I have done direct equity also, but 80% of my corpus is in mutual funds because that is a tool to create long term wealth creation. For long term wealth creation, it's always good to invest directly through mutual funds or invest in mutual funds rather than investing through the equity side. Now, why people don't invest in equity? That is also very, very critical. If I talk to a senior person, that is, if you talk to your parents and tell them that let's invest in mutual funds, many a times the answer which will come is they'll say it is risky because negative returns have come in the past. One of the question which was asked to me, that in the frequently asked question I'm going to cover, can we have negative returns in mutual fund? 100% negative returns are possible. Mutual funds can give a lot of negative returns also. So how do you manage that? What happens? How do you protect yourself from the negative returns? All that I'm going to talk about, because in my presentation you will see how can you escape from these negative returns. There are certain key strategies which are there which can help you in coming out of this risk which is there. Second, lack of experience. Why you don't invest is you are not aware as to what can be done. And many a times what happened is there is a fear which is there for the people that market can crash. If market crashes, you should never take money out. But during COVID time, when market crashed, most of the what to say the investors who are not there for a longer period, they are kind of an amateur investors, they kept taking the money out. When market crashes, you will take the money out. That is not right. Timing the market, people try to find when will the bottom be there to make fresh investments, and I should exit at the top. Practically both are not possible. Nobody can find when is the bottom and when is the top. 2 months back we were telling our clients, not, we were saying maybe the market is at the top, we can wait and make investment, but we still started with SIP for all our clients, because it's impossible for a person to find when it is the top, when is the bottom. So equity investing versus mutual fund investing I have discussed, where equity is like you treat yourself, your health issues are being treated by yourself. Mutual funds is basically you go to a doctor and the doctor treats you. You can decide which works well for you, because depending on the problem, do you need to go to a doctor or do you need to treat yourself? You will have to take a call, because some people will feel okay, I can treat myself. Some people will feel no, no, let me go to a doctor and then get my treatment done. So that is a broad difference between direct equity versus the mutual fund investment. There's a question which has come: are all AMC trust? No, AMC is not a trust. AMC is a mostly, there are AMC which are even a listed company. So AMC will be company. Trust is an in between person. Trust is an in between person which is there. Now, I talked about this investing early versus late in my initial presentation. But now I'm going to show you two people. There is person A and there is person B. Both are planning to retire at the age of 60. That's the time they are planning to retire. So retirement is going to be at the age of 60. And see what has happened is one person started investing at the age of 25. they did a monthly investment of 10,000 rupees. A small investment was done by them. Rate of return which mutual fund normally gives is 12%, and your duration till retirement is 35 years, and you invested 42 lakh rupees. That is what person A did. Person B started at the age of 35. The difference is 10 years difference. One person started at the age of 25, another person started at the age of 35. So 25 is one person, 35 is another person. Now, some of you could be at the age of 25, some of you could be at the age of 20, some of you could be at the age of 30, 35, 40. There's nothing like this is the age to start. You can start as early as possible as long as you have disposable income. Because there's also a question which has been asked to me, what is the age to start making investment? There's nothing like a starting age. You can make investment. Warren Buffett, who is considered to be the biggest investor, he has told, I think he started at the age of some 11 or 12, and he still felt that he has started late. So there's nothing like when should I start making my investment. Now look at the difference. You'll see the magic here. See the difference. Person who started at the age of 25 got a wealth of 6.5 crores, and person who started at the age of 35 got a wealth of only 1.9 crores. Look at the huge difference which is there. That is the magic of compounding. The magic comes. Your mutual fund investments can give you that magic if you start early. Starting early is very, very critical, because in my presentation, I am going to talk about certain key lessons. Before, ultimately, I'll tell how to invest in mutual fund also, but I'm giving you those key lessons. The first key lesson you see here is the power of compounding. That is, yeah, as clearly said by Monica, it is the power of compounding which you are seeing here. 6.5 crore vis-a-vis 1.9 crore for a small difference of 12 lakh in investment. You invested 12 lakh less, but your net worth is down by around 4.5 crores. 4.5 crores is the difference. So that is the moral. The lesson which you learn is start investing early in life. Start investing early in life. That is the biggest lesson I want to give it to you all. In fact, I was very happy that I'm going to touch base with some of the young investors as well, because you will start making investment. And I think I'm very grateful to SICASA, and you should be very you should thank SICASA for giving this such a good platform, because the platform which they have created where they are educating people about investments is an excellent platform. So I'm very, very happy that they could think about such a platform, and teaching people about this is an excellent initiative by them. I'll talk about the second one, saving versus investing. Now, what is the saving versus investing is? This is going to talk about an imaginary two people. There is a person called Kavita and there's a person called Kavya. What Kavita did is she saved money and put this money in a savings account. In a savings account, which will give you 3% return. Savings account, the interest in a savings account, obviously, 3%, 4%. That is what this is going to give. So a person invested in a savings account and that was giving a return of only 3%. That is, they did only saving, they did not think about investment. Another person invested in mutual fund. I'm talking about 10% there. In fact, mutual fund can easily give you 12% also. I'll talk about how it gives 12% as we proceed. But a mutual fund could have generated easily a 12% return itself. So this Kavya invested and she is invested at 10%. 30 years later, the Kavita's investment of 10 lakh rupee, only one time investment. You just did one time investment. There is an SIP investment. I'll talk about SIP lump sum as we proceed. But this 10 lakh became 25 lakh. How can I retire with only 25 lakh rupees? Because I have so many more years of life which is beyond me. So I cannot retire now. But what Kavya is getting is 1.75 crores. Kavya is left with 1.75 crore, and this person Kavita has got only 25 lakh. Both invested 10 lakh. Both invested 10 lakh. Kavita is unhappy. Kavya is very, very happy. Kavya is very, very happy. She is thinking that she can now go ahead and retire. So she has reached the age of retirement because she is able to make investment. She is able to make investments. And that is what is happening in case of Kavya's investment as compared to Kavita's investment. Let me, in fact, show you a calculator for retirement, because I think people did talk about this, saying that they want to know how to do goal based investing. So I'll show you a calculator. Now, in this calculator, you can plan for kids' education, kids' marriage, retirement, wealth accumulation, lump sum investment, goal based investment, how to decide what will be the EMI, inflation. So there are different calculators which are there. Let me talk about the retirement calculator. This could be useful for your parents or somebody who is listening who is planning his retirement. Let's take what is the person's current age. Let's take it is 35. Let's just take 35 is the current age. The person wants to retire by the age of 60. You can have your own expectation. Somebody can say 60, somebody can say, let me bring it down. I can keep playing around this 50. Life expectancy after retirement, that is after retirement, how many years are we likely to live? Let's take 50, I retire, and another 30 years is my life expectancy. Today I need monthly today, let's assume 1 lakh rupee. 1 lakh rupee, that is my today's requirement. Every month I'm needing 1 lakh rupee. It's a very good calculator. It will give you these calculators are available in our website. You can just use these calculators and do all computation which you need. Inflation, you'll have to take a call. Let's take 6% as the inflation, because that is what is normal inflation in India. Return on investment, there's a pre-retirement return and there's a post-retirement return. Both are very critical. What is pre-retirement is, that is when you are working. At that time, how much return are you going to generate? See, when you are of young age, you can invest in risky security. So let's assume mutual fund gives you 14%. And once you retire, post-retirement, you'll get only 6%. You'll invest in lesser risk. What this tells us, if this is your requirement, you need to create an SIP of 1,39,880 per month, and this will give you 8 crore 47 lakh. You can now change this. If you feel this is not working, then increase your retirement age maybe to 60. In that case, you'll have to save only 56,000 per month. You'll have to save only 56,000 per month, and your target amount will be 15 crore 17 lakh, but you have a longer period to make investment. So this is what is going to happen. So 15 crore 17 lakh is the amount you can get if you do investment for a longer period. So you can invest for a longer period, you can invest for a shorter period. So that is something you can decide. How do you want to make your investment? So this is on retirement planning. Like this, you can do a lot of goal based investing. The site is going to provide you all that. Kids education, how many years you want to save this, what is the current rate, how much is the return you want to generate, what is the inflation. It will tell you how much SIP you have to create. So ultimately it will tell you how much SIP you should create for the different goals you have. Somebody has asked me for our website name. That website name is lkradvisors.com. You just click lkradvisors.com. You go to, in the home section, you will have the SIP estimator where you can do all your calculation, and you have calculators where you can do goal based kind of investing. So you can look at different goal based. It's in fact financial planning is something which gives me a lot of happiness when I do, because when you play around these numbers, you'll get a lot of clarity as to how you can do your retirement planning, how you can do your kids education planning, kids marriage planning, or if you want some goal based, you want to do a travel. For travel you need some money. For different, you want to buy a car. Let's take a goal based investment. I need 30 lakh in 5 years, and I'll earn a return at the rate of maybe 12%. I want to buy a car worth 30 lakh. This means you'll have to create an SIP of 36,000. You create an SIP of 36,000, you will get 30 lakh rupees in 5 years, and that can help you in buying your dream car. So You can have different goals. So whatever goal you have, put that requirement, and this calculator will let you know how much you need to invest. I'll get back to the learnings which I was saying. So the first learning I talked about is starting early. The second learning is saving alone is not enough. You should invest in right asset class. Right asset class means you have mutual funds, you have savings account, you have equity, you have direct equity, you have cryptos, but think which can help you in balancing your risk as well as return. So both can be planned in such a manner. Next, the third important learning I'm going to talk about is understanding inflation. What is this inflation? How does that impact our calculation? So I'm going to talk on understanding inflation, because inflation is something which can erode my wealth fully. What happens is, 5 years back or 10 years back, I was able to meet my expenses 10 years back with 20,000 a month. I can meet my expenses. Now I need 50,000 a month. By the time you retire, you may need 1 lakh a month, or 2 lakh a month, or a 3 lakh a month. So your requirement, or the money which you need, will keep going up. So somewhere inflation is something which needs to be managed by you. If you're not managing the inflation aspect, you will struggle. So it is very critical that you manage the inflation aspect. Expenses will keep increasing. Today's 30,000 will become 40,000, 53,000, and it will reach 1,72,000 in 30 years. And value of money, what you were doing with 1 lakh, now you can do only with 17,000. That worth will be only 17,000. So with 1 lakh, what you were getting, now you'll get only goods worth 17,000 with that. So inflation is always very, very critical. You will have to manage the inflation aspect. If inflation is not managed, it can significantly impact your return. So I am talking about these three key rules. One is start investing early, person A versus person B. Second is saving versus investing. What is critical in saving versus investing is, if you invest, you should invest in the right asset class. Investing in the wrong asset class will not give you returns. And the third part I want to talk about is the being aware of the inflation aspect, because inflation is something which is going to significantly impact the returns. I will give a pause of a minute or a two at this stage, because I would want to take up any specific questions if you have. So I'll give a pause of a minute or a two for you to register so many things, because I've explained a lot of things. So let me take a pause of a minute or a two. If there are points from your side, I'll take those questions, and then I'm now later on going to explain how to invest in mutual fund, why to invest for long term, what is short term investing, what is SIP, what is lump sum investment. So the important parts I'm going to cover in maybe another 2-3 minutes gap. there's a question I've got. Investing 20K in equity, will the max loss will be suffering will only be 20K, or will it be more? Uh, Equity investment, your maximum loss cannot be more than 20K. If you have invested 20K, your maximum loss will be only 20K. But there are people who do FNO kind of an investment where there is a possibility of a margin call and all. But in equity, your maximum loss will be only 20,000 if you have invested 20. Okay, I'll now proceed ahead. Okay, now this is the most important slide I want to focus on. Whenever you make investments, always invest for a long term period. Short term period investments can be very risky. If you see in the slide, you see that when a person invests for a long term period, whenever an invest person is investing for a long term period, he is going to invest. If you keep an investment horizon of at least 7 years, if you keep an investment horizon of at least 7 year time frame, you see the return has always been positive. You do not see any kind of a negative return. In the short run, markets can give you trouble, but over the long run, markets have always been giving positive returns. Markets always give positive returns over the long run. It is only the problem in the short run. That is, when you invest for example, you see the worst here. In January 2008, market gave negative 50% return. That entire year of 2008, when the great crisis happened in US, that time Indian market gave 50% negative return. 2011 market gave 24% negative return. So markets can keep giving you negative returns. It can keep giving you negative returns in the short run. But if you invest in long run, let's take our analysis is 5 to 7 year period. If you take a 7 year horizon and you invested in the worst market, what is the worst market? Is 2008 when the crash happened. Then also you're generating a 6% positive return. That's the worst market. That's the worst market. Otherwise, you generate 17%, 28%, 18%, 14%, 13%. So look at how the Nifty has given returns over the last so many years, and market crashes, market does not crash, you are kind of protected. You are kind of protected. That is what the benefit you get if you invest for a longer period. Investing for a longer period always gives this benefit to people. Invest for a longer period so that you are able to generate healthy return. In this is lump sum return. I'll be talking about something called as SIP return. SIP is in fact better than lump sum return, because in SIP we have something called as averaging. What is averaging? I'll explain. But whenever you invest for a longer period, you do not see any red there. Red is basically negative return. So Nifty has never given negative return if you take more than 4 year horizon. And that is also the worst market. I'm talking about the worst possible market was January 2008. That was the worst possible market. In the worst possible market also, we are generating positive returns, which means if you are investing in the peak, you're investing in the bottom, doesn't really matter. Start investing. If you start investing, Nifty will generate you or will give you very good returns. I'll take some of the questions which have come. Can NRIs also use our website? In that case, how should they invest? Yes, NRIs are investing through our website. You can connect with me later on. I'll give my contact details. I am not taking as that part of the presentation. In amount required 5 lakh, where to invest to get after 8 years? Uh, okay, so Saket, if you want to get 5 lakhs after 8 years, what amount to be invested, we can check in the calculator and then let you know. You can just check in our website. But where you can invest in mutual funds. How to make investments, I'll explain it. So you give me some time, I'll explain how to make investments. There I'll also tell you how to select a mutual fund. You can select a mutual fund. How to do that selection will also be explained to you. uh, what is average cost per unit? That is called NAV per unit. What is NAV per unit is the when you make investments in mutual fund, whenever you're making investments in mutual fund, there is going to be something called as value per unit. Like you have a share price, here, instead of a share price, it is called net asset value per unit. So market has never given losses in long term. You see the heading, people will be very happy. But the problem is this: markets will always be volatile in short term. Markets in the short run, you see so many negatives. February 20, I think that was the COVID time. February, March 20, market crashed by around 20-25%. November 21, Feb 22, November 2018, Feb 2016, August 15, May 15. Markets will keep giving you negative returns. Be very clear. Be mentally prepared that you are going to see negative returns, because that has to be clear in your mind. That is what we keep telling our clients. That is, invest for a longer period, but be mentally prepared. Be mentally prepared that you are going to have losses. You are going to have losses in the short run. So short run losses are possible. In fact, I'll show you certain other key data points which will give you that perspective which I'm talking about. But mutual funds, be mentally prepared that it can give you negative returns. Negative returns are very much possible through mutual fund investment. But yes, over the long run, which you see this slide, be happy with this slide, be a little sad about this slide. So this slide can give you that happiness which you want, and this slide is where the what to say, the pain sometimes the students are the pain sometimes the investors face, because that pain will be there. You will have to go through this painful process, because markets can be volatile in the short run, but long run markets will give you return. Be happy about it, generate returns, and then create your long term corpus. That is what I want to say about investing for long run. This side, the short term volatility is going to be there. So another important learning which I have already told you, the important learning is invest always for a longer time horizon. The investment period can be more than 5 years. That is what we normally advise our clients. That is, you should invest at least for a minimum period of 5 years. I tell this even in my class to students, that you should invest in at least for a period of 5 years. Minimum for a period of 5 years investments are needed. Certain questions I've got: can a minor invest in mutual fund on his own? Minor, if they have a PAN card, then if they complete KYC, investments can happen. Obviously minor will be represented by an adult person. Mostly the parent will be representing them, but investments can happen in the name of minor. Resident foreigner having a OCI card invest in mutual funds. We have there are certain country specific restrictions are there, so we'll have to check what are the restrictions country specific. If those country specific restrictions are not there, investments have happened. We have clients who are investing from other countries. Market returns of last 10 years. Look at the bigger picture. What is the bigger picture? You started with 5,000 and now the Nifty is around 20,000. So 4 times increase has happened from 5,000 to 20,000. But in the medium term, in between, you saw markets crashing. Markets will keep crashing. The market is not going to be like this. You will keep seeing crashes in between. Markets will keep giving crashes in between, but it's always critical that you stay invested for a long term period. So market will always give you pain in the short run. When COVID crash happened, I personally invested a lot of money in mutual fund and equity. I increased my investment at that time because I was very sure that market will recover. We are going to see recovery was something which was very clear in my mind. So when I'm very clear in my mind that recovery is going to happen, why should I not invest more money? So I kept on investing more money when crash happens. So when a market crash happens, you should invest more money. That is what you should do. On the contrary, people take money out. So market always over the longer run has given fantastic returns. These are different categories which are there in equity. I'm talking only about equity part. In equity, there are multiple categories of mutual fund. I'll show you all this, but in practical world, you have lots and lots of mutual fund. You see number 680. The number can be even more than that also, because there are lots and lots of mutual funds are there. So how do I select a mutual fund is always a painful process for people. But see what kind of returns the different sectors have given. Banking sector over a period of 10 years, let me take a 10-year return, 11% return. Thematic consumption 16%, dividend yield 13%, ELSS 15%, equity international 7%. So something has given lesser also. But you look at on an average 14% is the 10-year return. These are historical returns which should give you that happiness that yes, investing in markets is good. I can invest in different category. I'll discuss about this category. I'll show you practically how to get this data point. How do you select mutual fund on your own as we proceed? But you see the fantastic performance of mutual fund historically from 14.3% on an average, 11.17% for a 5-year period, 19% for a 3-year period. But 1 year was only 4%. This is not today's return. This was calculated by us maybe a year back. That time market was not at its peak. At this stage, if you take the return, the returns will be even higher than that. Even the 1-year return is going to be very high. So this is the historical returns. I'll take certain questions which have come. For Jan 2020 COVID time showed opposite peaks. How do we read them? Sorry, Meena, I'm not getting the question. What do you mean by opposite peaks? I'm not sure. But and don't read charts. Don't get into any of that. You see, when market crashes, put money. When market is going up, also put money. That is called SIP mode of investing. I'll discuss that as we proceed. Relationship between stock market and mutual fund, both are very much interrelated, because mutual funds are investing only in the stock market. They are investing in the stock market. Only thing is, when you invest on your own, you don't know where to invest. So you invest in some good companies, some bad companies. Mutual fund normally will try to invest in good companies. Do we need demat account? No, demat account is not compulsory to invest in mutual fund. Uh, if I'm investing in SIP mode and market crashed beyond 20%, is it advisable to stay put or stop or pause SIP for some time? If you have invested, market has crashed, be happy. Don't stop your investment. Double your investment. If you have money, double your investment, or at least continue your investment. We normally tell double down your investment in case market crashes. So if market has crashed and you have money with you, please go ahead and double your investment. That is what I normally advise people, that go ahead and double your investments. SIP versus lump sum. I'll get into this. SIP versus lump sum. What is lump sum? Is making only one investment at a time and then not making any more investment. SIP is a small amount is invested at regular interval. You're regularly going to invest small amount of money. In a lump sum, you invest a large amount at one go. Both has its own set of advantages and disadvantages. Lump sum comes into picture when I have got some huge money. For example, I got some bonus in my office. You want to invest that, you'll have to go through lump sum investment only. You cannot keep waiting. Inheritance, that is, you got some money from inheritance, or a gift has come on a special occasion. All that time you can make a lump sum investment. Lump sum is slightly riskier. Why is it riskier? Is because when you're investing in a lump sum, you could be investing at the peak of the market. If you invest at the peak of the market, then market crashes, you get impacted significantly. SIP, what happens is, you invest in peak, market crashes, you again invest, market further crashes, you keep, because you're investing every month. So it will lead to averaging of your cost. On the downside also averaging will happen, on the upside also averaging will happen. So SIP is always a better measure. SIP is always a better measure as compared to a lump sum investment. But lump sum also sometimes people do because they have got some lump sum money or huge money has come to them. Who can invest in SIP? if you are having regular money every month, if you can invest a regular amount every month, you can go through SIP mode of investing. Otherwise, lump sum mode of investing is preferable. If you have only some specific amount, you cannot invest every month and all, then do lump sum. I will always advise people to go through SIP mode of investing, because SIP creates a saving habit, because every month you have to invest. When every month you have to invest, that saving habit will come through SIP mode of investing. Lump sum, that saving habit will not come. So that is why it's very critical that you go through SIP mode of investing. Now, long-term wealth creation through systematic investment plan. Now, what I did is, because I want you to show practical information. Without showing practical information, you will not understand how is this happening. So I'll show you now practical data as to how you can go for better investment, or why long-term investment is better. So what is the practical data I'm going to share? What I did is I analyzed the returns of my own clients, because I cannot give the client names and all, but I'm giving you overall holistic view. The holistic view is, in the month of March this year, Nifty was at 17,000. In 1 month, Nifty became 18,000. Then it became 18,634. Now it has reached around 20,000 itself. So Nifty kept on changing. In the month of March, 68% of our clients had losses. 68 percentage of our clients had losses in the month of March. But in 1 month, 68% became only 5% losses. And by the month of May, 88% of clients got more than 12% return, and today almost 100% are more than 12% return. So in markets, you will have to stay put for a long period of time, because in the month of March, market crashed little bit, but doesn't really matter. Market crashes, market does not crash. If you continue investing for a long period of time through SIP mode, you will see the benefit. So this chart or this table should give you that comfort that yes, I can invest for a long period of time, and if you invest for a long period of time, the probability of getting negative returns is almost nil if you invest for a long period of time. There's a question, which is better, investing in stocks or mutual fund? Devagar, it depends whether you can treat. I gave this example earlier also. That depends. See, uh, investing in stocks is, if you have any health issue, you can treat yourself, or you can go to a doctor and get treatment. When you treat yourself, when you have small issues, some fever is there, when you treat yourself on your own, that is like investing in stock. Your knowledge is needed, but you do not have knowledge of this, then you want to take a help of a financial doctor. That financial doctor is a mutual fund manager, so you take a call, what is better. Investing in stocks can give more returns than mutual fund, but it also has its own set of risk. Then I'll talk about another element called a step up SIP. What a step up SIP is, when you're making your investments, SIP means making regular investment. What is SIP is? Making an investment every month, systematic investment plan. So a person is going to make a regular investment, that is called SIP mode of investing. In SIP mode of investing, we create long term wealth. In that, I have two types of investment. One is called normal SIP, and another one we have step up SIP. What a step up SIP is, every year you will increase the amount of investment. How can you increase the amount of investment every month? For example, when I'm working in a corporate, I get monthly salary. If I'm getting monthly salary, after a year my salary will increase. After again a year, my salary will increase. So if salary is increasing, expenses increasing, saving can also increase. Your saving can also increase. So that part you can make investment, that part can be invested. So step up SIP is, you are increasing. Here I'm doing an annual increment of 2,500. When you increase only a small amount, which is 2,500, you again see an impact on your wealth. 52 lakh wealth has become 74 lakh wealth when you are doing this step up SIP. As you increase your income, as you grow older, you can try to do step up SIP. There's a question that is conversion possible between lump sum and SIP. No, there's nothing like a conversion here, friend. Lump sum is making one time investment. So you've made the investment, that's all. You cannot do anything beyond that. SIP is every month you are making an investment. In case you do not have money to invest in a specific month, then you may have to stop your SIP. How is that done? I'll explain as we proceed. So there's something called as stopping your SIP. All that I'll discuss as we proceed. In the frequently asked question, I'm going to discuss that. Longer the period of investment, better the stability in returns. My focus is only telling you people that you should invest for a longer period. What we did is I analyzed the 3-year, 5-year and 10-year returns for every month, that is from January 2020 till March 2022. That also had March 2020, the worst month, because COVID impact was there. That was the month when COVID led to a huge crash in the market. Despite that, a 10-year SIP return was positive 1.67%. See, it does not mean that you will suddenly take the money out, okay? You will have to stay put. So when market has crashed, if people had stayed for some time, that 1.67 becomes 14.33. So it's always good to invest for a longer period. And if you're in shorter period, 3-year SIP negative 14%, 10-year SIP positive 1%. So when you're investing for a shorter period, it can lead to lot of volatility in performance. Longer period, stability in performance comes. Okay, now comes the important question, because a lot of people have asked, how do I start investing in mutual fund? First thing is you'll have to complete your KYC. KYC is know your customer norms. You need a PAN card. You will need a Aadhaar card. PAN and Aadhaar needs to be linked. You will need a cancelled check leaf or bank statement. These are basic documents which are needed for you to complete KYC. KYC can be completed either through your bank or through different forms. So you can complete your KYC through bank account, to the broker account. Broker is, there is a Zerodha, there's a Paytm Money, there's a Kuvera, there's a Grow. So all these are brokers where you can do your KYC, or you can go to AMC website. AMCs, you have an AMC for ICICI Bank, you have an AMC, ICICI AMC, you have an Access AMC, you have a Reliance AMC. So different AMCs are there. You can make your investments through the AMC. Visit the AMC website, or you can also do it through mutual fund distributors like us. We are also a mutual fund distributor. We use a platform called Asset Plus. So you can do it through multiple ways. So you will have to complete the KYC and then start investing. Sign up, complete KYC and start your investment. Any question on how to start investing? Because now comes the practical angle. I've already explained the theoretical angle. Now comes the practical angle, because we are going to see how to start investing in mutual fund. So if there are any questions on how to start investing in mutual funds, you can type it in the box. I'll take them as time permits. Next, how do I select mutual fund? Because in the market, there are so many mutual funds are there. Around 1,000 mutual funds are there. How do I select which is a good mutual fund? Like in stock, selection is difficult. Similarly, people may find it difficult to select a mutual fund. So how do I select a mutual fund? These are certain filters. But before I go to the filters, let me show practical way. What you can do is you can go to Value Research Online. This is a website, Value Research Online. Go to their website. Once you go to their website, you will find this funds. In the funds section, you are going to get historical data. That is, this data is there. That is, which are the different funds there, what are the returns which are being generated. So you can get data about the various funds which are there. You can apply different filters. So let me talk about this fund category. We have equity funds. In equity, you have large cap, you have large and mid cap, you have flexi cap, you have multi-cap, you have mid-cap. Let me put all equity funds, all category of equity funds I've selected. I'm selecting all of them in my filters. Apply. I want to now look at their performance. So just give me a minute. Just give me a minute. I'm not able to remove this screen. Okay. Okay. So let me get back to this. So these are the different funds which are there. So you go to that funds. In that funds, you can go to returns. You can go to returns where you can see historical short-term returns. You can look at long-term returns. You can look at SIP returns. So what you can do is go to this, look at the SIP returns and just arrange here 10-year SIP returns. 10-year SIP returns. These are the best performing 10-year SIP. Nippon India Small Cap Fund 25.75% is the 10-year SIP return. 25%. 5-year return is 36%. 3-year return is 34%. Quant small cap. Look at how is the performance. 1 by 9, that is top ranked. 2 by 16. Out of the 16 funds which are there for a 5-year period, this was ranked second. 1 by 23. So almost in all the time period, this is doing well. Quant tax plan. Rank 1, rank 1, rank 1 for 3-year, 5-year and 10-year. SBI small cap, rank 2 for 10-year, but in the shorter run, it's not doing well. Rank 23, rank 15. So you will have to see how is the ranking of this. So look at the historical returns and then decide how you want to invest. So what I'm trying to explain here is you go to this, there are 770 funds which are there. So how do I apply or how do I find which are better? So go to the fund category. You decide which category you want to look at. I wanted to look at all equity funds. In equity, we have multiple categories which are there. So I wanted to look at the all equity funds category. Then I went to short. You can look at short-term returns also. This will give you the performance for 1-year period. You can go through long-term return, short-term return. So that's your wish. This is 1-week return, 1-month return, 3-month return. So which is the best performing 1-year return is, just put a click here. 82% return is coming from Mira Set. Sorry. 82.23% is the return. Again, it got removed. Sorry. By Mira Asset, NYSE, FANG plus ETF. Axis Nifty Small Cap is giving 50% return. So different funds are giving different returns. You have 1-week return and you also have your long-term return. So you can look at this and then select. So that is what I'm talking in my filters. That is, decide the category in which you would like to invest. 20 categories are there. At least minimum 3-year period they should be in existence. AUM means how much funds are they managing. Minimum 1,000 crore they should manage. Then look at 3-year return, 5-year return, 10-year return. Look at the background of the fund manager, expense ratio, and then select the fund. One question has come, can we continue trading in equity share or is there any restriction on it? I'm not sure about any restriction by ICI. I don't think there are restriction, but I normally don't advise any students to do equity trading. We normally advise them to go for mutual fund investment. If you don't want to do this headache of going through so many funds and getting into this, the another option is called passive approach. There's an active approach and there's a passive approach. Active funds invest in a lot of risky companies, try to generate superior returns. Passive funds is investing in index funds. Index funds. What is index funds? Is in your category of funds, you will find index funds also being there. In the returns category, let me look at the fund category. It will come either in the large cap or there can be a separate category called index. So in your large cap, in your large cap, let me unselect this. I'll select the equity large cap. In my equity large cap, you will see different funds which are there. ABSL Nifty 50 equal weight, Nifty 200, Nifty next 50, Nifty next 50 ETF. This Nifty names which you are seeing, are Sensex name which you are seeing, are index name which you are seeing. All these are index funds. They are normally very less risk. They normally carry very less risk. They are called passive funds. So you can invest in Nifty funds or Sensex 30 funds. These are considered to be relatively less risky. They are considered to be relatively less risky. But whichever you do, whether you do active funds or you do passive funds, do it for a longer period. Some more questions have come. Can you please explain which type of fund, equity or debt or mid or large cap, is suitable for article student with low income? Mahita, I would suggest you to go for equity funds. Either go for equity large cap or equity index fund. They are preferable because they have lesser risk. A lot of buzz is going on Parag Parikh MF. Is it good for students also? Parag Parikh MF is one fund which has performed very well in the past and it continues to do well. And I have a positive view on that fund. So Parag Parikh has a flexi cap fund which can be invested. It's a good fund. If you're asking my view on that, yes, it is a good fund. So we have an active fund, we have a passive approach. Whichever approach works, go to value research, select your category, look at 10-year returns, look at 5-year returns, look at 3-year return, and then select. In case you are not finding time to all this, you can invest through certain mutual fund distributor. I am also a mutual fund distributor. So we will select the funds for you. We will monitor your performance and then see how the investments have to be done. But that's your wish. Now coming to the taxation side, because some of you have also asked us on the taxation aspect. So taxation depends on whether it's an equity mutual fund or a non-equity mutual fund. If you are an equity fund, your short-term capital gain tax rate is 15%. Long-term capital gain tax rate is 10%. In long-term capital gain, more than 1 lakh is taxable. Less than 1 lakh is not taxable. Non-equity funds, which is debt fund, the taxation is as per your individual slab. If you are in 10% slab, or sorry, 5% slab, 20% slab, 30% slab, depending on the slab rate, the tax rate is going to be there. As far as the non-equity funds are specified, equity funds have lower tax rate. Your non-equity funds or your debt funds have higher tax rate. When should I exit a mutual fund? Because I have told how to invest in a mutual fund. When should you invest? What kind of investments to be done? When should you exit us? You should exit your fund if they are not performing well for a continuous period. They are continuously doing poor performance as compared to the benchmark. If there is a continuous poor, the Parag Parikh MF had a poor performance in between. It had a poor performance for a shorter period. So shorter period poor performance should not tell you to exit a fund. But if you have poor performance for a longer period, you should exit. The strategy of the AMC has changed, or your goals have changed. You wanted money for 10-year period, but now you want immediately money after 3 or 5 years. Then you'll have to exit a fund, or for the purpose of diversification. Now I'll get into the frequently asked questions on mutual funds. These are questions which we keep hearing from people. I'll answer all of them, and then I'll take specific questions from the audience as well. Before I get into the frequently asked question, in case there are any other questions, do let me know. I'll take up those questions as well, and then I get into the specific questions which I have prepared. There's a question from Mahita. How can we find the commission rate charged by different mutual funds along with their performance? That is called expense ratio. There's an expense ratio which is there. I think the value research website can give you the expense ratio as well. You can find the expense ratio, fees and details. So the expense ratio is here, 0.91, 1.01, 0.32. So you can look at this from the website. So the expense ratio could be there in the website of the mutual fund. So when you look at the mutual fund website, they will mention that what is the expense ratio is there. Expense ratio can hit our returns. So you can look at the expense ratio from this side, and whatever analysis you are doing, one good part is all this, the long term returns, the short term returns. For example, the long term returns, you can just give me a minute. You can export this data into Excel. So after exporting this to Excel, some issue in the site as of now, I'm not sure, but I'll show you the output which I will, yeah, take it. I'm able to take the output now again. So you can export this data and then do analysis on this data. So you have the historical data, 3-year return, 5-year return, 10-year return. So you can look at the data of some 166 mutual fund. I've taken the large cap funds. You can take up any kind of funds, look at their performance and then decide. You can take out the output of even the expense ratio. So any data you want, you can take it for a longer period and then analyze it. Any other questions if there, I'll take it up. Otherwise, I go to the frequently asked questions. I'll wait for a minute. Okay, let me now take the specific questions. What is the minimum investment in mutual fund? There's no minimum limit. That is basically some funds have a 500 rupees limit, some funds have a 1000 rupees limit, and some funds have a 5000 rupees limit. So minimum you can even start with 500 per month. That is the minimum investment in mutual fund. So that is why even in articleship, people can start with investment in mutual funds. Can I lose money in mutual funds? What are the risks associated with investing in mutual funds? Yes, you can lose money in mutual funds because I had shown you that there are negative returns which are possible. So markets can give you negative return. Mutual funds can lead to losses for you. But yes, over the longer run, it will give you return. It will give you return. So can you lose money in short run? Yes, you can lose money in short run, but over the longer run, losses from mutual funds are on the limited side. Whatever questions are coming in the chat box, I'll take it in the end. How do I select the right mutual fund? What are the parameters? So right mutual fund can be selected. Either first decide whether you want to go for active strategy or passive strategy. So decide whether active is what you want to do or passive is what you want to do. In active, you can go through historical 3-year return, 5-year return, 10-year return, category average, who is the fund manager, how is the expense ratio. Based on all of that, how much is the AUM? Based on all these filters, you can select certain funds. Passive one, you can invest in any Nifty index or a Sensex index mutual fund. So that is what you can do for your active versus the passive ones. What are the ratios to look at? You can look at, there are technical ratios which are there. You could have learned about this, or you would learn about this maybe at CA final. There's something called as a Sharpe ratio. There's something called as a Trainor ratio. All these ratios are already calculated and given there. So you need not worry about calculation. The websites like Value Research will already calculate this. So higher the Sharpe ratio, it is better. Higher the Trainor ratio, it is better. So you can look at these ratios also, or look at items like expense ratio, historical returns, and then decide. What is NAV? How is it relevant? And mutual fund with lower NAV better. What is NAV is basically like a share price. Like you have a share price, you have a value for a mutual fund. You have a value for a mutual fund that is called net asset value per unit. How is it relevant? It is not that much relevant and all. It does not matter whether the NAV is lower or whether the NAV is higher. People say that I will invest in a mutual fund with an NAV of 10 rupees and not in an NAV with 1000. Doesn't matter, because you'll be getting proportionate units. So whether you have lower NAV per unit or higher NAV per unit, it does not really matter. You can make investments in any kind of fund, even in shares investment. It does not matter whether you have lower share price or higher share price. You will have to look at what is, when you do share analysis, we look at what is P multiple, what is the market capitalization. So it does not matter whether it is lower NAV or higher NAV, and funds with lower NAV are not better. Let me make it very clear, they are not better. Then I'll take up some of the questions which have come in the chat box, and then I go to the next slide. How can we, sorry, there's a question, is that expense ratio charged only at the time of investment or periodically they'll charge on our investment? So Mahita, there is nothing like charging on your investment. They do not charge you anything on your investment. Whatever returns are getting generated, from the returns, automatically the expense ratio is deducted. So there is no separate charge which is done to an investor. If you're investing 10,000, you will get units worth 10,000. You are not going to get lesser units or more units. There is nothing like lesser units or more units. Does value research also an MF distributor? I think yes, value research is also an MF distributor. How to look at the background of the fund manager? So what, who is a good doctor? You know, so a good doctor, you try to get look at his historical performance. What is historical performances? You check with their patients. So similarly, look at historical performance of the fund manager. A fund manager does not manage only one fund, he may be managing multiple funds. So look at historical performance of the fund manager. That is, you see how he has performed over 3-year period, 1-year period, 5-year period, 10-year period. Not only in this fund, he could be having, there can be an SBI small cap fund, there can be an SBI value fund, there can be an SBI ESG fund. If all are being managed by a single person, look at how is the performance and then decide how is the performance of this fund manager. Some other questions which are there: which sector funds are good to invest in? Sector funds are considered to be extremely risky. Now, which funds do you invest? Please take a call based on your market expectation, because if you see in the practical world, let me show you the different sectors which are there. Fund category, we have sectoral banking, sectoral infra, sectoral pharma, sectoral technology. Theme based are also there: consumption theme, dividend theme, energy theme, ESG theme, MNC theme, PSU theme. So different categories are there. Which sectors are good depends on what is your expectation. Pharma sector could be good at some time, banking sector could be good at some time, IT sector could be good at some time. So depending on the expectation on that sector, you can decide. Our expectation as of now, IT sector is likely to do well, so you can maybe look at IT sector funds at this point of time. How often should I review my mutual fund portfolio? uh, Minimum once a year. Even if you review once a year also, it is sufficient. But in case you want to review it more frequently, every 6 months. Don't try to review on a monthly basis and all. Best is once a year, but in case you want to monitor it little better, you can try to do 6 monthly. That is, every 6 months once you can review your performance. What is expense ratio and what are its impacts? So someone did ask me on this. Expense ratio is basically this AMC. The AMC is managing your funds. When the AMC is managing the funds, they are going to charge certain expenses for that. They have a research team. You have to pay salaries to them. There is an office. You have to pay rent for that. There are assets like laptops and all. You'll have to pay infrastructure cost on that. You also be needing certain IT related cost. So all these costs together is called the expense. If the expense ratio increases, the return for me will go down, because my return is the residual return after meeting the expenses. So I should try to ensure that the expense ratio is on the lower side. We should not worry much about the expense ratio because SEBI has certain restrictions on expense ratio. So people cannot be having a very high expense ratio. There are a lot of restrictions on the expense ratio. So it is very critical that the expense ratio part is under check. You cannot keep investing a lot, or you cannot randomly keep investing money or increasing your investments or increasing the expense. How do I track the performance of a mutual fund? Please track the performance of mutual fund. Please track the performance of mutual fund through multiple ways. There are multiple ways of tracking. One best way of tracking is how is the mutual fund performing as compared to the markets, as compared to the market. When Nifty is going down, my mutual fund is going down, don't worry about it. When Nifty is going down, your mutual fund is going down, please don't worry about it. But when Nifty is going up, when Nifty is going up and your mutual fund is continuously going down, there is some trouble. There is some trouble. So you track the performance of the mutual fund in relation to what is happening in the market. Are mutual funds safer than direct stock investments? Yes, they are better than direct stock investment. That is why they also give lower return, because when the safety is there, obviously the returns are also going to be on the lower side. So mutual funds are indeed safer than direct stock investment. So it can end up giving you lower returns, comparatively not very low returns and all. It can still give you 12-14%. In fact, many a times in my case, my mutual fund returns are better than my direct stock returns. It is better. Let me be very clear on that. It was better for some time. At this point of time, direct stock is better than mutual fund. On an overall basis, direct stock is turning out to be better. But there was a time period when mutual funds was better than my direct stock. I'll take some of the question which has come. Sources to learn about mutual fund investments. Any recommended books or website? I think you can go through website like Value Research Online. Your AMFI has a website. Association of Mutual Funds of India also has a website. On the books part, I think there are few books. I may get back to you on the names. There are certain books which are available. You can just send me a message. I'll let you know the books which you can refer. Or I think I have a slide on that. I'll show you the books which you can refer. Just give me a minute. I'll let you know the books part. Because a question has come on books, so I'll give you the books information as well. So just give me 1 minute. See, I'll get back to you on the books part because I had a slide on that. I'll get back on the books part alone, Abhinesh. Let me go through the other thing. How much allocation should I have in mutual fund? As I said, you should try to invest in multiple asset classes. Uh, See, equity mutual fund is where you should make your investments. How much should you invest depends on the age of the person. If your age is, in case you are 20 years, 100 minus your age should be the allocation to equity. 100 minus your age, 100 minus your age should be the allocation to equity. So if you are 30 years of age, 70% should go in mutual funds and equity, 30% should go in debt. That's the allocation you can keep. When should I start investing in mutual fund? Earlier the better. It's always earlier the better. There's no age for investing in mutual fund. As early as possible. That's always true. What happens when you miss SIP payment in between? SIP is where you make regular investments on a monthly basis. If you miss an SIP, there can be certain penalty charges which can be charged by your bank. So in case you have created an SIP and you will not be able to fulfill the commitment, what you can do is you can pause the SIP. You can pause or cancel the SIP at any time, but don't allow an SIP to be missed. If you miss an SIP, there can be charges for that. But you can pause your SIP in case there are certain financial issues and you are not having money in a specific month. Please pause your SIP. Can I sell my mutual funds any day, so I might invest for long term? investment is always for a long term period, but yes, you can exit from a mutual fund at any point of time. So somebody wants to exit from a mutual fund, you invested today and you want to exit after 5 days, possible, but there will be certain cost associated with it. There can be certain exit clause and all, which can be exit load, which can be there. Also ELSS funds, ELSS is ATC benefits. These funds have a 3-year lock-in. You cannot exit before 3 years. Why does disclaimer say mutual funds are subject to market risk? I think in my presentation I did talk about mutual funds can give negative returns, and that is why mutual funds are always subject to market risk. So that is something which is unavoidable. I think these are questions which are from my side, the frequently asked ones, which I thought. I have put my mobile number there. You can contact me with your doubts if you have anything specific on mutual funds. And now I'll also take up the questions which are there in the live chat. So there are some other question. Folio mode or demat mode is better. Both are same, friend. Doesn't really matter whether you invest in folio mode or in demat mode. Both does not really matter. Both are same. So whichever is convenient for you, you please do. Mutual funds also have beta value. Yes, you can look at the beta of mutual fund again from a website like Value Research. Higher beta indicates higher risk, lower beta indicates lower risk. What are the tax liability related on income and amount invested? Whatever capital gain you generate, Garudat, whatever capital gain you're generating, short-term capital gain is taxed at 15%, long-term capital gain is taxed at 10%. That is on the taxation angle. That's how the taxation is there. Next question. Can we do multiple SIP on the same mutual fund? Yes, you can do multiple SIP on the same mutual fund. You can create even 2 SIP, 3 SIP, 4 SIP. That's your wish. There are people who even do weekly SIP. What is weekly SIP? Is every week they'll do an investment. So they will invest on 2nd, then they'll have an SIP on 10th, they'll have an SIP on 17th, they'll have an SIP on 24th. So you can create SIP, multiple SIPs are possible. That is very much possible in mutual fund investing. If there are other questions, I would also want to take up that. Okay, there's a question from Adesh. There is a recent news that mutual funds are investing into tech startups which are risky. Yes, this is a challenge which is there. So that is why when you're selecting mutual fund, you should try to select funds which are good. We have a policy that we don't select those funds which are investing in these risky tech startups. So we do look at, for example, if you look at, there was a recent IPO which happened of Mama Earth. That IPO was priced very high, and some of the mutual funds did invest in that IPO. So we are of the belief that we should not go for such mutual funds. So that is a call you will have to take when you're freezing or when you're selecting your mutual fund. Exit load is charged at flat rate. Yes, it is a percentage. It will be given in the when you're investing in the mutual fund. Any exit within a 1-year period, most of the mutual fund charge an exit load of 1%. Are ETF comparatively better? ETF is basically, I told initially that there is an open-ended fund and there is a close-ended fund. So the close-ended fund listing is needed. That listed fund is called exchange traded fund. So basically that is also a mutual fund only. There is technically no difference between a ETF fund and a mutual fund. Can you suggest any best mutual fund? So Garudat, in my presentation I've explained how you can select your best mutual fund. You can just go through all equity funds in this value research online website, and you can go to the return section and go to returns. I think the website is throwing up some challenges, but you just go to the return section. There is a long term return and there's a short term returns which are there. So long term returns and short term returns, you look at that and then you do your ranking based on that and then decide which are better. uh, in my case, I'll give you one name which is a very good mutual fund, which is Parag Parik mutual fund, or ICICI Prudential Value Discovery Fund. These two funds are very good mutual fund. Parag Parik Flexi Cap Fund and ICICI Prudential Value Discovery Fund. Which one is better, either Zerodha or Grow? Bharat, your wish, you can go with any of them. Both are doing well. Both are good brokers. So we have same view on both. What is ETF? ETF is exchange traded fund. When you have close ended funds, whenever you are having close ended funds, it is mandatory that they should be listed in the market. So that listed fund is called exchange traded fund. The trading is going to happen. What is exit load? What is exit load is, if you are investing in a mutual fund and want to exit the mutual fund in a shorter period, that is, you invested for a 10-year horizon or a 5-year horizon, and you invested and immediately in 5 days you are saying you want to exit. So the mutual fund manager is going to say, if you are doing an early exit, I am going to charge you an exit load. So that is called exit load, where they will, whatever money you were to get, in that they will deduct 1 or 2 percentage and then give you the money. Can you explain ELSS mutual fund? ELSS is Equity Linked Savings Scheme Mutual Fund. These are ATC mutual fund. In ATC, there is a tax benefit which is there. This ATC benefit is around 1.5 lakhs. So in that, ELSS mutual funds are there, which are also investing in equities only. They are investing in equity. What if a fund doesn't perform well? Abhinesh, it can happen that a fund doesn't perform well. So monitor performance. You do a review every 6 or 12 months, and if the fund is not performing good for a longer period, please exit out of the fund. So it is possible that is why we normally suggest that you should invest in 8 to 10 funds. If you're investing in 8 to 10 funds, what will happen is you are investing in so many funds that if one doesn't perform well, others will take care. So you start monitoring the performance and take an exit call if performance is not good. Thanks, Saket, for this the good words from your side. Thank you. Kevin, I think we have taken all the questions. If there are any questions, you can let me know.
Yes, sir, you have covered.
Sure.
Friends, is there any other questions? If you have, please put it in the chat box.
In your firm, is there any minimum portfolio requirement for your clients? Is it only for HNWI? No, mutual fund, there is nothing like a limitation. We have clients who do even 500 per month to 5,000 per month to 10,000 per month. So there's nothing like that. In mutual fund, cannot put any restriction. Thanks, Meena, for the words.
If you don't have any other questions, please fill in the chat box. We can conclude.
Show the return view and value research. Okay, there's one question. They want me to show the value research website again. I'll show it to them. I think value research website is down maybe. Let me see if I can show it. Just click value research online. Go to this funds. In the top funds, it is not uh, in the funds. Go to explore more funds in screener, and here you can decide fund category, all equity funds. This website, I know some challenges are coming today, but in the fund category, just select all equity funds and then, okay, I think we have selected it and apply, and then you can keep checking it. Okay, then there is a question. Are the mutual fund units also traded just like the shares in stock market? Open ended, there is no trading. Close ended, there will be a trading, because close ended, it's mandatory trading has to happen. Jana, what about the books? I think there are few books which I have just checked. You can have How to Select Mutual Funds in India. There is a book by Mr. Mukherjee. You can just check this, How to Select Mutual Funds in India, or you can go through Indian Mutual Funds Handbook. This is also a good book, Indian Mutual Funds Handbook. This book is by Mr. Sundar, and 108 questions and answers on mutual funds. These are the three books our company prefers. I just checked with my partner. These are the three good books on mutual funds. So if you want to read, please read about these three books: How to Select Mutual Funds in India, Indian Mutual Funds Handbook, and the third book is 108 questions and answers on mutual funds and SIPs. Abhinesh, there's a question. How does the price of ETF determine? Price of ETF is determined based on the NAV only, but demand and supply also plays a part. Because trading is going to happen. When trade happens, your demand and supply can have an impact. But but it is always based on, most of the time, it is based on only the NAV. That is the base NAV. Yeah, Monica, ETF is for trading for your close-ended funds, correct? Uh, Kevin, I think we have covered almost everything now.
Yes, sir. Thank you so much. And that, ladies and gentlemen, that concludes our session with the incredible CA Dinesh Jain, sir. We trust that you have gained a lot of valuable insights and a deeper understanding of mutual funds. A huge thank
Kevin, I think we have lost connectivity. I
Sorry,
think we
I
lost
think
connectivity in between.
my phone got
ठीक है, not a problem. मतलब I think we have covered everything.
one
Thanks,
second.
thanks, thanks for this opportunity, Kevin.
Yes, sir.
Keep arranging such good sessions for students. I think they will benefit out of it.
Sure, sir, definitely. I think we can conclude.
Sure. Thanks, Kevin.